Hello guys, welcome to your first lesson of the box system. In this lesson, we're going to understand what boxes are, how to draw them, and what to expect from the price when it breaks out of them. So first thing we need to understand clearly is that every single thing that trades in the market moves in two phases. Either the price is trending, which means it's creating a series of higher highs and higher lows, or lower highs and lower lows, or it's non-trending, which is whenever the market is not trending, it's just chopping around. So how do we identify these periods, the trending and the non-trending ones? Because that makes all the difference in what we should trade. You have to remember that when you trade one security, it means you're putting your money in it, which cannot be now used for trading anything else. That's opportunity cost, right? So if you're stuck with your money in a security which is just moving sideways for years, not moving up or down, you are just stuck with it. And you're wasting your time, you're wasting your energy, and that money is not making any more money, which is not how you want to do things. If you want to invest, try and invest in opportunities that compound fast. So let's see how to identify such opportunities today. So the first thing we begin is with zones. I will give you an idea of zones in this video, but I have created another video fully on zones explaining every single detail, and it's free for all members of HU 2.0 and War Room, so go check it out if you haven't already. So what are zones? Zones are important price levels which act as supports and resistances. In this case, for example, before I drew this box, let's identify some zones. Alright, you can see clearly that this price level is a zone. Why do I say that? I say that because look at this. Acted as support. As long as the price was above it, the path of least resistance was higher. Price crossed below it, the path of least resistance is lower. Acted as resistance here, price went lower. When the price went higher, acted as support again. Before price broke below, acted as resistance, price went lower. So all it means, a zone is a level above which the path of least resistance is higher and below which the path of least resistance is lower. You can see it acted as a resistance a bunch of times here, here, acted as support here before the price finally broke up. Same way we can define the top of this box boundary as a zone. I have drawn these boxes, but I will explain how you can draw them for yourself too. Let's identify the zones inside the box in black color. Alright. Is there another zone in this box? Let's see. This looks like a zone around 120. Same concept, acted as support. I can zoom in to see if the boundaries are correct. Maybe slightly lower because of the price action here. Perfect. Acted as support, price went higher. Acted as support again. When it went low, price went lower. Acted as resistance, price went lower. Alright. Now, in a similar fashion, I had defined this, the 101 level as a zone. You can see acted as support here, acted as the resistance when the price broke below. And I had defined this as a zone around 169.30 because it acted as a resistance a bunch of times. So once I had defined these zones, and you can define these zones if you are having any trouble finding the exact boundary for it, you can go to a lower time frame. Don't go anything below 4 hourly because then you will have a lot more noise. But you can go as low as 4 hourly to know the exact price at which the zone should be. Like this one, for example, can be slightly lower. When I'm making my watch list every single weekend, I'm very precise with this, but since it's an example, I'm not paying attention to a 50-cent difference here and there. Alright, so once you have defined these zones, you want to look out for periods in time when the price is not trending. It's not creating a series of higher highs and higher lows, or lower highs and lower lows. You see, it's just choppy. It's spending time between these two zones and just moving sideways. So what we can say is the price is not trending between these two zones, the $100 and the $169, and this are the box boundaries. These are your box boundaries. Boxes are simply helping us define the period in time where the price is not trending. It helps us define the price range in which it's not trending. What we can expect is once price breaks out of this box, it will trend. If it breaks out higher, it will trend higher. If it breaks out lower, it should trend lower. So that's how we define our boxes. How does this help us gain an edge? Because we can expect once the price is done consolidating here, which is when the collection by all the institutions is happening, those are the ones that will push the price higher, and then more and more people will get in, which will keep pushing the price higher. These boxes are the periods when the institutions are getting into stocks. They don't want to get in when the price is going higher. They don't want to get in when the price is going lower because they have too much capital to invest, so they like to get in small amounts over periods of time which are not trending. That's the accumulation phase for institutions. So once we have defined our box boundaries, we try to understand how the price will move out of them. The reason I've picked Roku as an example because it was a beautiful box in 2020 which broke out perfectly, and it will help us define many of the things we want to see or you should be looking out for when you're looking at boxes. Alright, so once the price breaks out of this box boundary, it can move in three ways. One, it just directly goes, right? No issues, it just directly goes higher, no pullback. Those are the craziest one to catch because they move so fast, you want to pick up some profits expecting a pullback and they just keep going. The second way the price can move out of these boxes is it will go higher, pull back, retest the top of the box boundary, and then go higher. And the third way would be the price goes higher out of the box, comes back, retests the bottom of the first zone, and then it goes higher. You see, as long as the price is inside the box, this first zone is the low, right? Will be the area where the price should not go below it if it wants to create a higher low. So if the price breaks out of this box, for example, in this case of Roku, it comes back and creates a low above this first zone, that's a higher low. You see, a higher high, higher low. And then it can move higher. So another higher high, higher low. So you see a trend has already begun in this case. This first zone is important because the price stayed above it in all three scenarios in which a breakout will happen. A direct breakout, a breakout retest of the box boundary, a breakout retest of the first zone, and then higher. Those are the three scenarios the price can go if the trend has started. So we know if the price falls below this first zone again, the trend hasn't started yet. It was a false breakout. We are still in a non-trending period. What it means is this first zone should act as your stop in every single case of boxes. Every single one. This is non-negotiable. You can find your own trailing stops based on your objectives. But if there's a box, this first zone is the stop in every single case. So like the stop I place in my trades is usually slightly below this first zone, because that allows for the retesting to happen and without getting me stopped out. Alright, so once the price has broken out of this box, you see we have a trend starting. And what is a trend? In this case, it will be a series of higher highs and higher lows. We created a higher high here around 185, came back, created a higher low because the previous low was the first zone around 145. Now the higher low was around 153. Went back, created another higher high at 200, another higher low at 175, and voila, we had the blow top part of this rally. So why am I explaining this trend, or why am I paying attention to this? Is because all trends have a certain structure. Once a trend starts, the price moves in a certain way. And once you understand how the price moves, it helps you anticipate what a trend should do. It helps you anticipate to get out in case the market breaks down or the price or the trend structure breaks down. If the trend structure breaks down, you don't want to be involved anymore. You want to be out in cash safe because you don't know what the market is about to do. So let's see how the trend structure works. The trend structure, what I have noticed, is between two non-trending periods. The way things trend is it creates two sets of higher highs and higher lows. So Roku is a perfect example because it happened beautifully in this case. I will describe it properly in this one, and then we can discuss cases where it might not happen. But the usual trend structure is you have a breakout, you create your first higher high, you pull back, you create your first lower low, then you break out, break out again, go above the first higher high to create your second higher high somewhere. We will have another pullback, and you will create a second higher low. This higher low, the second higher low has to be higher than the first higher low. Then the price starts going back up again, goes above this, above the second higher high, and this part of the rally now is a blow off top phase. In which case, this is the final part of the rally. And this part of the rally ends when the price moves below the low of the previous day. So you have to pay attention. You should be out of this trade as soon as the price moved below the low of the previous day in this part of the trend. So again, we have the first higher high, a pullback, a first higher low, all right, then a second higher high, second higher low, and then the last phase of the rally is blow off top. If at any point, let's say we created the first higher high, created the first higher low, created the second higher high, and then the price just falls back below this, the first higher low. In that case, the trend is over. The trend structure is broken down. We should not be in the trend anymore. We should be out. That's basically it. That's the trend structure. So in this example, in this video, we have learned about zones. There's another in detail video about zones, so go check that out. It's free in HU 2.0. Don't miss it. You have learned about how to create boxes. We have learned to figure out when a trend starts, what the price does when a trend starts. There are three possible scenarios. Keep them in mind. And what the trend structure looks like. If the price stops following the trend structure, it means we have stopped trending. You want to be out of those. You don't want to be inside in a trade if it has stopped trending, because that's what's the point of it. You are setting yourself up for failure, either a deep pullback or just chop for months on end. We don't know. One last thing to mention is even though I mentioned that over every single market trends and has a trending period and non-trending period, there are some markets that trend better than others. What I have noticed is companies working on innovative technologies, growth stocks, they trend really well. Retirement stocks, dividend stocks, and Forex doesn't really trend that well. There might be small trends here and there, but it's mostly very choppy. And I don't want to be sitting around trying to figure out a trend in retirement stocks to get a 5% gain when I can be in a tech stock and get a 50% gain in a year. So that's how I differentiate which universe of stocks to trade. Alright, that's enough for the first video. In the next video, we'll learn about the types of boxes.